All right, let's get right into it. Today, we are doing a serious deep dive into one of the most aggressive and, frankly, one of the most heavily fought over state tax policies out there, New York's convenience of the employer rule. Now, if you're a non-resident who works for a New York company, or you advise clients who do, you absolutely need to understand this. This isn't just about good tax planning. This is about survival in an audit.
So here's how we're going to tackle this. We've got it broken down into 6 key areas. We'll start with the basic problem, then get into the nitty-gritty of the legal framework. Look at the specific forms that trigger an audit, and then wrap up with what you really need to know to handle all of it. Let's jump in.
First things first, let's frame the issue. What we're really talking about here is a major collision between the new reality of remote work and one of the most stubborn, far-reaching state tax rules in the entire country. And believe me, it impacts thousands of non-resident employees every year.
Now, this seems like it should have a straightforward answer, right? You'd think your income is earned where you physically are when you do the work. Well, that's not how New York sees it. Their answer to this question catches a lot of people, even seasoned professionals, completely by surprise.
And here it is. This is the heart of the whole issue. New York's default position is that if your company's office is in New York, then 100% of your income is considered New York source income. It doesn't matter if you're working from your home office in Florida. In New York's eyes, that's a New York workday, unless you can prove, beyond a shadow of a doubt, that it was an absolute necessity for you to be outside the state.
Okay, so where does this rule actually come from? Let's dig into the specific legal framework that New York uses to build its case, because this isn't just some vague policy. It's written right into the law and regulations. You're going to want to remember these 2 citations. New York Tax Law Section 631 is what gives the state the authority to tax non-residents on income they earn from New York sources. But it's the regulation, 20 NYCRR 132.18, that gets really specific and defines what a New York source actually is for someone telecommuting. You need to pay very close attention to the wording here. This one phrase, of necessity as distinguished from convenience, this is the entire battlefield. Every single audit, every legal challenge, it all boils down to how New York interprets the employer's necessity. Not yours, the employer's.
So how in the world does New York define necessity? Well, they've created this very specific multi-part test to figure out if your home office qualifies as a Bona Fide Employer Office. And spoiler alert, it is designed to be incredibly difficult to pass.
This memo right here, TSB-M-06-5I, this is the auditor's playbook. It lays out the exact checklist they use to disallow your out-of-state workdays. If you're preparing a non-resident New York return, knowing this memorandum inside and out isn't optional. Just look at how this is structured. It's like trying to get into a fortress with very few gates. You either have to meet this one almost impossible primary factor, or you have to satisfy this complex cocktail of secondary and other factors. The bar is intentionally set sky high. And this is where it gets just about impossible for most telecommuters. Take a look at these secondary factors. You have to be holding regular client meetings in your home, or your employer has to reimburse at least 80% of your home office expenses. Come on. For almost everyone working remotely, those conditions are just not happening, which means it's an automatic fail.
Okay, so let's shift gears and look at where the rubber meets the road, the tax form itself. Because this form isn't just for calculations, it is the #1 thing that triggers these audits.
When you file your non-resident return and you try to allocate some of your income away from New York, you have to fill out Schedule A of Form IT-203-B. And you better believe the state's computer systems are programmed to scrutinize this form. It is basically ground zero for getting audited.
The math on this form is where the trap really springs. So you report your days worked at home on line 1J, but when the auditor comes in and says you failed the bona fide office test, they essentially treat that number as 0 for the calculation. So as you can see, those 150 disallowed home days get added right back into your total New York workdays on line 1L. The result? Your allocation often goes right back to 100%.
So you see how this is all set up, right? Understanding the rule and the form, it almost always leads to one thing for high-income telecommuters, an audit. And we're not talking about a simple letter asking a few questions. These things are intense.
The system is literally built to find you. You know, when your W-2 shows $500,000 in wages, but you only allocate $50,000 of that to New York on your return, well, you've just raised a massive red flag. Combine that with a Connecticut address, and an audit is pretty much a sure thing.
So once that audit is triggered, the state sends out what's called an Information Document Request, or an IDR. And the level of proof they demand is, frankly, forensic. We are talking about meticulous, day-by-day, contemporaneous evidence of where you were and what you were doing for every single workday of the year.
They are trained to find your electronic footprints. They will subpoena your E-ZPass records to see if you drove into the city. They'll look at your credit card swipes. I'm telling you, a single receipt for a cup of coffee you bought in Manhattan at 8 a.m. on a day you claimed you were working from home in Jersey. That can be enough to blow up your entire allocation.
And here is the real kicker, legally speaking. Landmark cases like Matter of Spindler have established that the state's assessment is presumed to be correct. The burden of proof is 100% on you, the taxpayer, to prove them wrong with irrefutable evidence. This leads to what we call the empty diary rule. Any day you can't prove you were outside New York is, by default, a New York day.
So after going through all of this, the law, the forms, the brutal audit process, what's the bottom line? What are the absolute must-know takeaways for any professional trying to navigate this mess?
Look, the single most critical point is this. You cannot afford to wait for the audit notice to arrive. Defending against this rule has to start on day one of the remote work arrangement. As an advisor, you have to get your client on a strict regimen of creating daily, contemporaneous records to defend the allocation that you will eventually claim on Form IT-203-B. And that, right there, is the question that every tax professional with a New York non-resident client needs to be asking. Is the plan you have in place really ready for this? Thanks for sticking with me on this deep dive.